Hi, Will. Are you there?
I am, Richard. Hi.
Brilliant. Thank you. Hi, Will. Thanks for joining us today. It's been good to talk to you. See how you're getting on. Shall I just hand over to you to quickly do a quick intro of the fund?
Yeah, absolutely. That's great. Hello, everyone. Thanks very much for listening. So, actually, Richard, if you go back one page, always interesting. This is a real estate fund, UK Commercial Property REIT Limited. We invest in diversified portfolio of commercial real estate across the UK, portfolio of approximately £1.3 billion. And the reason for looking at that, we funded a few years ago the construction of a hotel in Newcastle, Delata, who were in there. It's a fantastic hotel. Their occupancy rate has been great, and they've paid rent continuously to us through COVID and everything else. It's a fantastic mix of business and leisure hotel stays, as you can imagine. Newcastle. Sorry, Richard. If we go on to the overview, I mentioned a diverse portfolio, diversified by sector. We have a large exposure to industrial and logistics, and I'll probably talk about that in a minute. 60% of the portfolio, and a growing portfolio of student accommodation and hotels within there. We don't own any shopping centres or any high street fashion, which I think are difficult areas, and increasingly difficult. And many of your listeners might agree if you observe how people are using offices at the moment, a combination of environmental issues and agile working with COVID. We own very little offices. So mainly industrial and growing student accommodation, a bit of others. We have dividend yield at the moment of 6%, really strong operational performance. So our rents are growing, our earnings went up by 11% last year. But again, as I'm sure many people will observe or know, commercial real estate had a difficult end of the year, a difficult Q4 across the whole market, with quite a significant re-rating as gilts moved out and interest rates moved up. One would typically expect a decent margin over that gilts risk-free rate, and that in around autumn evaporated. So today it's a really interesting situation. We trade on a 30% discount. We offer a 6% dividend yield off current pricing. And I think we've got a really, really strong operational earnings story, rents increasing. The portfolio itself of 196 tenants, it's 98% occupied, which is good. And our rent collection was 99% last year. So again, very strong quality tenants by and large paying our rent on time. We have, as I said, a strategic focus on earnings growth. So I'm really keen with the board that we boost our portfolio, and we signed last week, which I'll talk about, some really interesting rent deals, seeing increases in rent last week of 70% on the rent tenants were paying 2 years ago on one of our industrial estates. And ESG, environmental, social and governance concerns, really, really important, I'm sure, across all your trusts, but in the built environment with real assets, physical property, the way that they're insulated, the way that they're energized, that is really important for us. And we've got quite a big focus on net zero carbon, how we achieve that with our targets, and also energy ratings similar to those that you'd have if you buy a fridge, A, B, C, D, E. But if we move on, Richard, if that's all right, to the next slide, thank you. So I'll nip through these quickly. We talked about quality income, and I probably have 4 quick stories. The existing portfolio, good bunch of names. The top 5 tenants that you can see on the screen there represent 22% of our income. People like Ocado, the government, Amazon will be familiar. Armstrong Logistics, the smaller company, great business in the Midlands in one of the UK's best distribution parks. They have a contract they manage with Aldi, very successful business. I probably expect Warner Brothers will drop down the list a little bit and be replaced with Total, following some releasing we've been doing. And in terms of growing income, in my world, I talk about something called reversion conversion. It's a little bit techie, but it's the ability to convert to cash the theoretical rental value of a property. So if we have someone, as we did, paying £10.50 for a square foot of industrial space, and we've just relet it at £17.50, which was actually ahead of its rental value, that conversion of old rent to rental value and to cash rent is what I call reversion conversion. And the table up at the top shows the potential ability to grow from a yield in the low 4s up to above 6%. On top of that, and I'll talk about them in a minute, we have a compact development portfolio, which is going to be bringing more income in there again. Thank you, Richard. If we could nip on to the next slide. There we go. And here we go on development. So developments done properly can add real value, I think, to a portfolio. And there are 4 that we have here. Collectively, I expect those to add £8.5 million of income to the portfolio at a yield on cost of 6.5%. And it's great. I mean, the fantastic thing about real estate is they're real. You can see the buildings. To the top left of your screen is a student accommodation block right beside Exeter campus. And I think it's a big advantage for students who are my tenants here that they can literally jump out of bed and in a few minutes be in their campus. So they find that tremendously popular. We completed phase 1 and it's fully occupied with around 130 students. And phase 2 is going to be completed around about March. Collectively, we've already sold 50% of the rooms here for the next academic year. So really strong scheme, very strong environmental credentials, which in that student population particularly is really important. Up on the right-hand side, this is a more complete development in Sussex, a place called Bolney. Bolney is also known for its wine production, but we don't do that here. We've let 2/3 of this to a company involved in geological surveying, and with what is happening in energy in the moment, they're really in demand. They sort of effectively use this as a data center with more people than you might have, and a third is under offer. So we expect that to be fully let very soon. And actually the rents here are around 12% ahead of the rents we expected when we embarked on this project. So that's a good news story. Bottom left, at the end of 2021, we bought a larger investment in Leamington Spa, let to a variety of people, including Iron Mountain and the NHS. It came with a smaller development site of around 80,000 square feet. And we're on track to finish this in Q1 in the next 2 or 3 months. There's smaller buildings. Again, our rents have jumped up from when we embarked on this project by around 15%, our expected rents. But here, because they're smaller, we expect really to finish them so that our tenants can come and look at them and then lease them. And the final one, and I mentioned at the beginning, branching more into the alternative sector. So anything that isn't an office, shop, or an industrial property, we group as alternatives. Student accommodation is one of those. And here we're building a hotel for Hyatt in the middle of Leeds. This isn't the most beautiful photograph, but please trust me on this. It's right beside Leeds Station in the heart of Leeds. And if anyone has stayed in Leeds, my experience has been expensive, poor hotels. So we're building a Hyatt hotel. It will have a rooftop bar. It'll be fantastic environmentally. Showers and heating are going to be electric. But actually the room rate here will be something like £95 for a room. So quite reasonable in that context. And that will come on stream later, probably around autumn 2024. So adding 6.5% return, if you like, yield on cost for all of those. Richard, thank you. If we could move on. Trying to bring that all together in a graph of where our rent might grow. So again, go back to thinking about a capital correction in value in UK commercial property happening in Q4 last year, but a strong operational performance. And this graph shows the potential in the portfolio to grow our rent by 30% from December 22, the blue bar on the left, working through the developments to the middle blue bar and up to around £90 million if everything is going on track. I should say it will never work out like this. This is a forecast. It requires everything to be 100% let. We're 98% let at the moment. So we will rent some buildings ahead of the rental value. Some will be below. We'll have some tenants leaving, but it's a trajectory of really strong earnings potential in the company, which we're really highly focused on. Richard, thank you. And just nearly finished touching on debt. Really important to be aware, UK Commercial Property REIT, with the board, we've managed debt very prudently. At the moment, we have group loan to value of 20%, and of that, around about 70%, 68% of our debt is on a longer term fixed rate basis. So we're paying 2.88% for that, so low cost. We have another facility which is flexible debt, and as you know, we all heard that Bank of England increasing their rates to 4%, so that will cost us a little bit more. But as a house, we actually, perhaps more bullish than some people, we expect that interest rates could come down. The bank will be forced to cut rates at the end of the year to around 2.5%. It's our projection, and then beyond that, stabling out at around 1 to 2%. So temporary increase on the debt, but most of our debt is on a low fixed rate cost. All our covenants fully met and managed very, very prudently. And I think my final slide coming up, if we go to the, all but one. Energy, I mentioned at the beginning, there are two things here in a nutshell which really matter for me and for the board, and I think should for anyone investing in real estate. The first is regulatory, and it concerns energy performance certificates. As I said, like when you buy a fridge or a television, it's going to have an energy certificate of A, B, C, D, E. Regulation is coming in which will require any building to be leased or sold by 2027 to be at least a C for Charlie rating, and 77, almost 80% of our portfolio is already there. So we work very hard when we're refurbishing buildings to improve them. And the leasing transaction I mentioned at the beginning, where we got a 70% increase in rent for very little money, we increased the warehouse EPC rating from an E for Echo, one of our two E's, up to B. So that was done very sensibly. The other point on this side, and again, all the companies that you look at will have this, is a goal for net zero carbon. Again, we take it very seriously if you think of the carbon produced from the energy systems in buildings. So by 2030, we expect the carbon that we control as a landlord will be zero. And by 2040, our whole portfolio will be zero. And a lot of that will be working with our tenants, whether we're putting, as you can perhaps pick out, the bottom of one of our buildings on Leamington Spa, where we have solar panels on the roof, a whole host of areas where we can improve that. LED lighting is one of the strong things that helps that particular situation. So that's on ESG. And then I think now coming to my final slide, the outlook. So I see, and as a house, we see UK commercial property in 3 stages, 1, 2, and 3. Phase 1 has happened, and that was a very sharp, in over 30 years, the fastest correction in real estate prices, commercial real estate that I've seen, brought upon by almost free money moving out as interest rates crept up, erosion of a risk-free rate, and that repricing. It was very much led by the industrial market. The industrial market was keenly priced on an expectation of strong rental growth. As we stand today, with 60% of my money in industrial, that correction has happened. So looking, I suppose, at the company now, it's a lot of that is in the price, if you like. And the operational performance of that industrial sector, for me, in the right place, a lot of money in London, undersupplied, is really, really good. Phase 2 is recovery. So operationally, we're doing well. Tenants want to lease our space. I think later in the year, should rates come down, as we think, towards around 2.5%, then there'll be a widening of the risk-free margin that an investor in commercial property can expect over 10-year gilts. So the sort of double positive whammy of strong operational performance, looking for earnings growth, rental increases, against a widening risk-free margin, which I think will make that capital side very, very interesting. And then phase 3, we providing the fundamentals of the real estate investments are right. Industrial, we're in the right place. I think that's good. Student market is good. We're coming into hotels. We have no shopping centres, no high street fashion, which I think is going to be at risk from people's disposable income shrinking. And we have very few offices. Offices I could talk for hours, and I won't, about, but probably one of the trickiest sectors at the moment, with a combination of capital expenditure needed to make them ESG compliant, but also companies and employees coming to grasp with agile working and what that means for demand. So on that note, I hope I've given you a quick flavour of what UK Commercial Property REIT is about.